This is InvestTalk. Independent thinking, shared success.
Hi, this is Adrian from Texas, and I had a question regarding KDP, Keurig Dr. Pepper. Is it a good time, based on the financials, to get in?
Short, sweet, to the point. Keurig Dr. Pepper, ticker KDP, is probably a name you recognize, maybe not because you've followed the company, but because you drink Keurig coffee or you like Dr. Pepper. Now, I don't drink Keurig coffee, but as a child, loved Dr. Pepper. That was my favorite soda. I don't drink soda anymore, but certainly it brings back memories every time I see one. And it's not just Dr. Pepper. They own Canada Dry, they own Mott's, they own Snapple. It's a huge brand because it's a $42 billion market cap company. Now, from a balance sheet perspective, they have a minimal amount of debt relative to their market cap, only about $16.6 billion, though notably that's up from $13.4 billion in 2021. So there's some growth on the wrong side that we don't often like to see. Cash flow also started slowing down in 2022, and margins started to contract in 2022 as well. You look over here, you see that they reached a high of about 16.9 in 2021, and then it was kind of downhill from there, though this year it's projected to be 17.1. So we're seeing a little bit of a resurgence. Now, what I know about KDP, Keurig Dr. Pepper, is there was a $1 billion deal announced in October to acquire a 60% stake in Ghost Energy, so expanding beyond the soda, coffee offerings into what's really been a more popular, growing segment of the beverage market recently. And so that does bode well for the company, but earnings have been mixed, right? 2024 was a pretty mixed year for them. You saw their coffee segment revenue fall, or rather growth slow, as their other beverages kind of rose, right? That's what drove them higher in terms of revenue growth, but that certainly has slowed. Look at this, 14.5% on an annualized basis since 2019. But really the growth is nowhere here, right? 2023 into 2024, from 14.8 billion to 15.3, that's not 14% growth right there. Most of the growth was really in the back end of this period. And so as you have slowing growth, well, these margins that look very attractive at 15 times relative to where it's been over the past 5 years is maybe makes a little bit more sense. Now, if you look down here at this comps table, what you'll see is, okay, some of its big competitors, Coca-Cola, Monster Beverage, well, they're trading at higher multiples. So does that make this an attractive name? Well, I mean, from a technical perspective, it's not doing too great. I mean, it's drawing down. It broke through some support around the 31 level. It's trading at 30.38 right now. There's more major support at the 30 level, but it's certainly not great from a technical perspective, and growth, like I said, is slowing. So for now, I would keep it on my watch list. I don't think now's a good time to get into this name, especially headed into a new year where there may be some policy changes related to really the core business of this name. I would have to pass for now. That's ticker KDP, Keurig Dr. Pepper. Now, as promised, and as I always say, we are more than anything a finance and investment question show. And so we already answered a voicemail. So why don't we dive into the InvestTalk YouTube channel comment section question bank? Remember, we are also a video show as well as a podcast. So if you head over there and you have a finance and investment question that you really want answered, well, just leave it in the comment section and we will get to it as soon as we can. This one is on ticker AMAT, and it says, let's see if I can go 3 for 3 on stocks you like. All right, Rowdy 1, 2, 3, 4, 5, 6, 7, 8. Let's see if you can do it. Thank you for answering my questions on HIG and AMG. What do you think about AMAT? I know you've talked about it before, but in the last 6 months, it's gone from 250 to 170. Is this a good time to pick it up? Let's take a look at Applied Materials. It's a manufacturing equipment and services company, and they provide equipment and software to the semiconductor industry and industries around the semiconductor industry. And so over the past 52 weeks, they're up about 15.5%, underperforming the market overall. Year to date, though, they're up 5%. And in the 3 month, they're down 15%. So a lot of volatility over the past 3 months. And so the demand for the fabrication equipment that AMAT provides has really been driven by the increase in need for advanced semiconductors and the surge in artificial intelligence applications. And so think about oil companies, right? Oil companies tend to fluctuate because of the underlying commodity, okay? In this situation, you have the manufacturing company that is providing that fabrication equipment. Well, they're probably going to fluctuate along with the semiconductor industry, and that's exactly what you've seen here. So they tend to follow the broader industry trends of the semiconductor industry. And in fact, the semiconductor industry, right, the industry we're comparing this to here, is up 3.3%. So this is barely outperforming the industry so far in 2025. Now it's $144 billion with a B dollar market cap company, and they have virtually no debt. And usually when we see companies that have virtually no debt in this sector, well, it's because they're issuing a bunch of shares. That's not the case here. They're actually buying back shares, down from 900 million to 800 million shares in the past 4 years. Cash flow is improving. Profitability is headed in the right direction, right? It's leveling off from some mid-pandemic highs over here where their EBIT margin was around 31. Their net margin was around 25. And it's stabilized, and it's actually improving. 26.4 was where it was last year. 26.3 is where it's projected to be this year. Revenue growing from 14.6 billion in 2019 to 27 billion last year. Now that's slowed a little bit, right? It's only supposed to grow another 3 billion this next year, another 2 billion, but that's 10%. So yeah, you're down from 13%, but now you're at 10%. So with all this in mind, what does it look like from a relative valuation perspective? Well, from a relative valuation perspective, it's trading at 18 times forward-looking earnings, 7.5 times its book value, 5.4 times sales. That's a lot. That's a big multiple over price to sales, but that's about where its average has been over the past 5 years. And so, as mentioned, it's down a bit. Its relative strength going back to 2019 is still incredibly strong, but it's moving closer towards a price to sales multiple that I'm okay with. Let's look at it relative to its peers. Yeah, it's trading cheaper than its peers. Its PEG ratio looks pretty solid. Its return on equity is in line with its peers, beating most of them. Its earnings per share growth year over year is actually positive. And so honestly, I think you might have done it. You might have been 3 for 3 here because I like what I'm seeing. I like the growth. I like the margin expansion. I like that they're not a serial issue of shares. I like that they're actually not adding lumps and lumps of debt on here. Their earnings have been upgraded. Their earnings per share growth looks solid. I don't know if it's quite there yet because it could continue to break down here. It's breaking down from, again, 250 down to about 160 is maybe where some more support is. But I'd be fine with you starting a dollar cost average in here. That is Applied Materials, ticker AMAT. Now it's Friday and we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year treasury yield is at 4.369% today. 24 weeks back is at 3.882. 62 weeks ago was at 5.05. The 10-year today was at 4.77. 3 weeks ago it was 4.609. Gold was priced at $2,687 per ounce today. 3 weeks back that was $26.26. Silver was at $30.45 per ounce today. 3 weeks ago it was at $29.41. The national average for a gallon of regular gasoline is $3.06, a 3-cent increase compared with its price 3 weeks ago. In California, it was averaging $4.38, a 4-cent increase from 3 weeks ago. For comparison, in Mississippi, gas was averaging $2.62 per gallon today. That is $1.76 less per gallon than gas in California. Thank you for watching.
If you liked what you saw, make sure to give us a like and subscribe for more informative content.
Hey guys, this is Darren in Charlotte, North Carolina. Got a quick question for you about PLTR Technologies. I got a position in it back in February 2021 where it was just about $29. And recently I see that it's up over $70. And so I was just curious what your advice would be to get out of it completely or maybe sell half my position and take those profits or sell the whole thing since it's gone up significantly since I bought it. So just curious what you have as a future forecast for PLTR, PLTR Technology. Appreciate it. Thanks.
Taking a look at Palantir Technologies, PLTR. Palantir is an AI adjacent company, right? They specialize in big data analytics. They create software platforms that integrate and analyze large data sets. And they also have quite a bit in government contracts that they got in the past year. It's a pretty volatile stock, right? This was a 340% surge in 2024, up 300% in the past 52 weeks, up 54% in the past 3 months. But year to date, it's down about 11, right? There's been a pretty significant pullback here. They're also a serial issue of shares. And because of that, they have very little debt. It's a $155 billion market cap company with $255 million in debt. And their shares have gone from about $1.7 billion to $2.3 billion in the past 5 years. Now, cash flow is improving, growth looks good, profitability looks solid, and all these things are fantastic. But what about the relative valuation? It's trading at 63 times sales. 63 times sales. And so with the growth forecast of about 20% year over year, doesn't really justify for me where this is trading. It's trading about 50 times projected 2029 earnings per share right now. And so you're up a lot. This could continue to crash down and correct, as if valuation matters anymore, it should. And so if I were you, I would start to trim this down. I would trim down a lot of it. I would probably trim down more than half of it. I would keep a little bit because you never know what's going to happen here, especially with a name like this. But it is very expensive. I mean, very expensive. 144 times forward-looking earnings, 34 times book value, 168 times cash flow. So certainly wouldn't buy in. Maybe this is the start of a deserved correction after a ridiculous 2024. That's Palantir Technologies, PLTR. Looks like we have our first live call. Jason from Illinois asking about NCLH. Do you own it or are you looking to buy it?
I do own a few shares. I was looking to purchase more shares. It's something that I've looked at for about 2 to 3 years now, and just wondering if is this in an uptrend, or is it a good time to buy, or should I just hold?
Cool. So let's take a look at NCLH, which is Norwegian Cruise Line Holdings. Now, Norwegian Cruise Lines is exactly what it sounds like. It is a cruise travel services company. It's an $11 billion market cap company. It's got quite a bit of debt, about $14 billion in debt, but it seems like a lot of that is pretty low interest because their interest coverage ratio is 3.6 as of the most recent quarter, meaning that they can cover their interest expense 3.6 times with their earnings before interest and taxes. Now, Norwegian's cruise line has had a pretty solid past 52 weeks, up 46%. Over the past 3 months, it's up 12%. And a lot of that is because of some pretty solid growth. Now, we looked at Carnival a couple days ago, maybe a couple weeks ago. I don't know, the time starts to meld, recently. But in a similar fashion, they had a pretty bad pandemic, which is to be expected. But out of that, it's been pretty stellar, right? They grew from $4.5 billion in revenue in 2022 to 8.5, from 8.5 to 9.4, so slowing a little bit in 2024, projected to be about 10.2 in 2025. But with that, their efficiency is getting better. Their margins are expanding from 1.9 all the way to 10.7 is where it's projected to be at the end of this year. Recently, they actually had a record high bookings in Black Friday and Cyber Monday sales. And earnings have looked more and more positive in the past couple months. Now, it's a little overbought, and the short interest kind of shows that. It's got about 5.6% short interest. Nothing too crazy there, but it's been on quite a run since June or July. So overall, I like the growth they have. I like their margins expanding, right? Margin expansion is exactly what you love to see. Cash flow improving is exactly what you want to see. But is it a little overbought? Well, it's trading in line with Carnival, trading at 12.3 forward-looking earnings. Carnival's trading at 13.4. Viking Holdings trading at about 15.8. So overall, I would say it's probably about fairly valued compared to where the sector is. I do like some of the dynamics heading into this year in terms of increased disposable income, maybe prices tamping down a little bit within the travel sector. So I think it's a pretty solid price to get into Norwegian Cruise Lines. If you don't own too much, maybe wait for a little bit of a pullback down to 22, 24-ish. But I certainly wouldn't sell it. I would definitely hold on for now. Thanks for the call. Now, the U.S. labor market closed out 2024 on a high note. How so? Well, it added 256,000 jobs in December, which was well above the expectation of 155,000. The unemployment rate also dipped to 4.1%, beating the forecast of 4.2%. And so this marks the biggest monthly jobs gain since March and highlights the economy's resilience after a mid-year slowdown. Now, despite the strong jobs numbers, markets reacted negatively, with major indices like the Dow and S&P 500 falling, right? They fell well over 1%. Investors are really concerned about, I would say, what this means for rate path policy. The strong labor market likely rules out further interest rate cuts at the Fed's meeting later this month or even in March. As I mentioned at the top of the show, they're now anticipating maybe the rate cuts don't even come until October. But there's a silver lining here. Wage growth continues to moderate, something that is the primary driver of inflation over longer periods of time. Average hourly earnings rose by 30 basis points to 35.69, in line with expectations and slightly slower than the previous month. And so this supports the Fed's view that the labor market is not really contributing significantly to any inflationary pressures on the horizon. Now, looking back, right, 2024, the U.S. economy was pretty solid. It added 2.2 million jobs, more than double what economists had predicted. Hiring was pretty concentrated, though, in sectors like healthcare, leisure, and the government. But December saw gains really spreading across. They saw them in retail and finance and professional services. And so this signals that it's not just a focused resilience, but it's turning more into a broader resilience. But uncertainty looms, right? Policy will change. Maybe new tariffs will be put in place, maybe widespread tariffs, maybe concentrated tariffs, a curb on immigration, which could inflate prices, right, by making labor more expensive. And so economists are warning that restricting immigration could really exacerbate some of the shortages we're seeing, and along with higher tariffs, start to increase consumer prices. And I think that's what's driving the Fed to be in a wait-and-see mode, right, balancing the strong economic data with the potential risks on the horizon. And so while the U.S. labor market remains a cornerstone of economic strength, policymakers and us as investors need to watch closely as 2025 gets into full swing.
Hey guys, I have a daughter. She's almost 1 year old, and I'm looking to start saving money for her, and I'm just wondering what the best options that would be. I've heard you guys talk about 529 plans before. I'm just wondering if I go that route, you could just give like a 30-second overview of what that entails. I think I've heard on the program before that you can actually buy a 529 plan from any state. You don't have to actually live in that state. And if that's the case, could you just go over one or two options, which ones would be the best states to go with? Thanks. Love what you guys do. Appreciate it.
So that's an important question because a lot of people are trying to save for their children's education expenses. And that's what a 529 plan is. It's a tax advantage savings plan for education expenses, which could include tuition, room and board, books, supplies, and parents tend to use it for college savings. There's different types, right? It includes prepaid tuition plans, which locks in tuition rates. So that would be within the state in which you have the plan. But there's also investment-based education savings plans. I mean, the important thing to note here is you don't really have to live in the state that's offering the 529 plan. You can choose any state's plan. And some states even offer tax deductions or credits for contributions, but it's important to know that it really differs from jurisdiction to jurisdiction. These benefits, these deductions, these credits really may be tied to using your own state's plan. And there are many different state plans, right? Some of the ones that I've heard of people liking are Utah's plan. I think it's called My 529. And that's because it has a wide array of customizable investment options, low fees. I think Illinois has another good one as well, Massachusetts, Pennsylvania. But I think the key here is when you want to select a plan, you should be thinking about the same things that you're thinking about when you're doing your normal investment accounts. How expensive is the plan? What are my investment options? What are the benefits? What are the costs? What is my goal? And even though maybe another plan looks like it's better in a different state, am I even eligible for those benefits? I know it's complicated, I know it's complex, but it is an important thing. And so doing your research is incredibly important. Thanks for the call. Let's keep things moving. Play 2 in a row.
This is Steve from Denver, and I'm interested in investing in copper, and I've been looking at symbols FCX and SCCO. I prefer SCCO, but I just wanted to check and see what your opinions were. Thank you.
Let's take a look at ticker SCCO. SCCO is Southern Copper. We have owned it on and off for clients. We currently own it for some of our clients in one of our investment strategies now. Now take a look at Southern Copper. Year to date, it's up 3.82%, which is way outperforming the market. But, it's only been about 10 days. For the past 3 months, though, it's down 18.2%, and it underperformed the market in 2024 by about 15%. And the reason why is, industrial demand, right? SCCO's revenues are closely tied to the demand for copper, just as we talked about before. An oil company is tied to the demand for oil. And copper prices have really been fluctuating towards the downside a lot in 2024, especially towards the end of 2024. Now, one of the benefits of investing in Southern Copper or any mining company versus investing in the commodity itself as well, they tend to be able to better control and smooth out your investment experience because you can cut costs, turn off mines, what have you. But I think overall, what a lot of people are thinking about now is a pause on the green transition. But there are more countries out there than just the United States. And I think that electric vehicles in Europe and China, production will only go up, even if the US starts to fall back in terms of its prioritization of electric vehicles. And so over the next couple of decades, copper is going to be in demand. It's also very capital intensive to get these mines up. And so we still think that long-term copper, even if demand is lower now, even if prices have taken a hit at the end of 2024, copper is still a good investment for the long term. And so if you're looking to invest in copper, Southern Copper, one of the, if not the largest of the exploration companies, is a good way to do it. That's SCCO, Southern Copper.
Get ahead in your financial journey. Sign up for the KPP Premium Newsletter and receive tailored insights every week.
Trying to find out if there's any truth to something that I've heard, and I'll try to explain it as an example. If I had 10 shares of Apple for a year, and in a year and a half I add another share, and let's say now I have 11 shares, are the 10 original shares still long-term gains? I had also heard that once you add to your position, that timing starts over. So just interested in understanding how that works. Appreciate it, and thanks again.
So that's not true. This is important because this is for taxes, right? This is for tax purposes. And so you're holding time for long-term versus short-term, and your cost basis is determined on a lot level. And so a tax lot is the amount of shares you purchased on a given date at a given time for a given price. Now, if you buy more shares when the price is higher, it will change your average cost basis. But for tax purposes, Uncle Sam only cares, or Uncle whomever country you belong in, only cares on a lot level. And so in this instance, if you bought more shares of Apple, well, your original shares would be long-term gains based upon the time at which you bought them for the price at which they were bought. Hope that clarifies. Thanks for the call. Before we head off in the weekend, I wanted to briefly touch on some changes coming down the pike on the financial regulatory front. And that's because key figures in Washington are signaling a rollback of financial regulations and a more welcoming stance towards cryptocurrency and also fintech. Travis Hill, vice chairman of the FDIC, the Federal Deposit Insurance Corporation, outlined his vision for the agency during a speech today. In that speech, Hill, who is probably going to become the FDIC chairman after the current chairman steps down on January 19th, called for a reduction in regulatory burdens on banks and a more open approach to innovation in the financial sector broadly. He criticized past efforts to impose stricter capital requirements on banks and emphasized the need for regulators to focus on core safety and soundness issues rather than what he described as process-related distractions. He also addressed the contentious issue of debanking, asserting that the FDIC should not pressure banks to exclude lawful customers based on their political affiliations or industries, including cryptocurrency. Now, meanwhile, Federal Reserve Governor Michelle Bowman echoed similar sentiments in a Wednesday speech. Bowman, a candidate for the Fed's vice chair for supervision, advocated for a balanced approach to regulation, suggesting that oversight should support economic growth while maintaining stability. So for the cryptocurrency industry, well, this is a pretty good pivot. This is something that they will like. Now, Hill also argued that the FDIC's current stance on digital assets has really stifled innovation and called for clear guidance to encourage adoption of new technologies. Additionally, the Trump administration is expected to scrutinize consolidation among federal banking agencies and consider shrinking their oversight roles. Overall, this could be good. It could be bad, right? We go through an ebb and flow of regulation. Some of the regulations they want to remove are ones that were put in place on the back of the 2008 financial crisis. We're talking about capital requirements, where the goal was to get banks to have a certain amount of liquid assets to cover their liabilities, to prevent runs on banks, and to prevent an issue where toxic assets by poorly collateralized securities bring banks down and lose customer money. But on the flip side, higher capital requirements means less money in the economy. It means it's harder to get loans for businesses. It means it's harder to get money out the doors. And so we don't know much yet of the effects of these, what the actual policy will be. Bank executives certainly are optimistic that the new administration will ease the restrictions on capital requirements, but also consumer protections. And so certainly the direction, if anything, the direction of U.S. banking policy will change dramatically in the coming days, the coming weeks, in the coming months. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You and they can get yours and theirs at iTunes, Google Play, and Spotify. But while you're over there, please be sure to leave us a rate and review. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button. This is a free and confidential service. Also, while you're over there, don't forget to let us know if you are interested in having us help you optimize the potential of your 401k. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.